If you've ever tried trend trading is very similar to riding a wild horse, and every turn the horse makes, it tries to kick you off its back, and that's what exactly a trend does to you. Now, another important point about trend trading is the longer you hold on to that wild horse, the more profits you would gain in the bargain. So today we'll talk to you about trend trading and counter trend trading and the secret of picking a calm horse so that you could ride these trends longer. So with that, let's get started. Now, the scientifically proven fact is that markets oscillate. The markets continuously swing between overvalued and undervalued levels, and that's how trends are formed. Now, the secret is to ride these trends to gain the most amount of profits by trending with these trends and staying on for the ride. So I'll show you now a few tricks of the trade on how you could stick on to a trend and also the difference between trends and counter trends. Now, to explain to you what trend trading is, I have the S&P 500 index in front of me, and this is on the daily time frame. So trend trading in its primary form means trading with the trend. So in order to tell you if this is a trend or not, you look at the moving averages. So in front of you, I have the blue line, which is the 200 period moving average, the purple line, which is the 50 period moving average, and the yellow line, which is the 20 period moving average. So these are just guidelines to tell you if this is in a trend or not. And the way to tell you if it's in a trend is that you will see these three lines separated from each other. So that's a trick on how you would know if this is a trend. So the trend trading in its primary form means that you buy, so this is around November 4th. You buy around this point in time, and what you would then do is ride this all the way to the end of this trend, and when you see the trend starting to decline, you will then sell it off. So trend trading is where you would sell it off when the trend ends or touches the purple line again. So that's basically you're riding the entire trend. Now, a lot of people would also start buying or adding to their positions if it comes and touches the line again. So for example, they would have bought here at around November 20th. They would then again add to their position on Jan 2021. And over here, if it actually crosses the 50 period moving average, they would sell. And that's how they would end their trend trading position. So that's like, there's different ways you could look at it, but in its primary form, it's buying and selling around the trend lines. Now, if you're talking about counter trend trading, what counter trend trading means is you will buy around this particular line. So say you bought it around the low of when it just kind of like moves about the 50 period moving average, that's a purple line. And you would sell as soon as you see it declining back again towards the purple line. And that's how you would make money back again. So for example, you would start selling if you see it declining a lot more. So they would short sell it here, and they would then recover the money here. Like, so this is what they would get. I'll show you another example. This would be, somewhere a good counter trend trading opportunity. So a trader would buy at this point, keep it, and as soon as it gets super extended, as in this case, they would sell, and then they would start short selling at this point, and they would short sell it and grab it all the way till it comes down to this point here. Now, one of the disadvantages of counter trend trading is that, as you can see, if you're trading with the trend, you do get a lot more leeway and grace period and a lot more runway to make profits, because you're basically making profits. I'm just going to zoom in so you see this particular chart. You basically make profits all the way till here. So you bought it at around, say around the 3018 mark, and then you sell it all the way to the 3500 mark. So that's a good amount of profit. Now, by short selling here and trying to grasp profit by the time it reaches back to the purple line, and that's because the markets do oscillate and have this elastic pattern where they get stretched and they come back again to the mean, and that's the area of value. So that's something you'll always see in every chart pattern. Most of the charts patterns will describe this to you. Now, the disadvantage that I mentioned to you is by doing this, you do not really know, is it going to bounce out of this yellow line, like how it's done here, or it's going to bounce out of the purple line. In this case, it did try bouncing back below the purple line, but if you look at a lot of instances, it just bounces back all the way to the yellow line. So your runway or the profit margin is not so much, and there is more chances of you losing money, because you could probably like gain a lot more by trading with the trend than counter trending and like trading the elastic band, pulling it back to the normal. So that's just my take. There are specialized traders that just trade counter trends, and that's what they specialize in. And what I would recommend to you is, if you are new to trading, choose one. Choose either trend trading or counter trend trading. The preference, in my opinion, would be to trend trading, so that you get a little more runway to grab onto your wild horse and like ride along the journey. So that's just my opinion. I hope you got some value out of this. Hope you could try applying this to your personal trading, style that you trade in your day-to-day life, and hope this is added to some value to you as well. So with that, thank you so much, and I hope to see you in another video very soon.